Hi everyone, welcome back to Saheb Academy. Today in this video we are going to talk about deferred income, an adjusting entry that we pass at the end of accounting period. And this deferred income is also known as income received in advance, pre-received income and unearned income. And this falls in the category of prepayments. Yeah, you all know popularly the adjusting entries are called as accrual and prepayments. In accrual we have two adjusting entries and in prepayments we have two adjusting entries. So this deferred income or deferred revenue or any of these names, income received in advance, it falls in prepayment category. Is that clear? All right. So in this video we're going to discuss this in very much detail. We'll take a huge example which will span 3 accounting periods and we'll practically understand what's the backstory, how the adjusting entry will be passed, how the reversing entry will be passed, and then how the ledger accounts will be prepared, the financial statements, how it will affect everything, right? We are going to get the overall idea about this adjusting entry and we'll be completely clear with this. Alright, but before watching this video, please make sure you have watched the previous videos of this playlist, adjusting entries, where in the first video we have discussed about adjusting entries, the entire concept, right? Basics of financial statements, and then how the adjusting entries are, planned part of the accounting process, isn't it? And then the different types of adjustments we have in final accounts, when we prepare the financial statements. Popularly, I told you adjusting entries are just known as what? These 4 only: outstanding expense, prepaid expense, accrued income, deferred income. And that's what we are learning right now. We have already covered outstanding expense, prepaid expense and accrued income in just previous video. And now we are covering deferred income, isn't it? See here, these are the 4 main popular adjusting entries. Yes. So we have covered all these 3 in the previous 3 videos, right? And then deferred income is the current video, right? And it falls in the prepayments category, right? And then what did we do after this? We understood the difference between the 2 accounting terms, accrue and due, by taking this small example. Okay, and then in the outstanding expense video we discussed about open transaction, the transaction which have occurred but not yet been completed in the same accounting period. It will be completed in the next accounting period, and because of this open transaction, what happens? Mostly 99% of the time will have an accrual or prepayment and will have to pass the adjusting entry and the reversing entry in the next period, right? Yeah, so we discussed this. And then in the second video we had outstanding expense, and then in third video prepaid expense, fourth video accrued income. Now this is the 5th video of this adjusting entry series. So let's understand what is deferred income. Now see here, we have the concept of deferred income. It's really simple and straightforward. You already know what are the alternative popular names of deferred incomes, which are income received in advance, pre-received income and unearned income. All right. But now what's the meaning of deferred income? See, it's really simple. Deferred means to postpone. Deferred means to postpone. Deferred income will be what? An income which is postponed. But why? Why are we postponing it? How does it make sense? You will understand. It will make sense. Let's just discuss this further. Okay. See here. Let's just read this. Deferred income is an income which is received in an accounting period but relates to the next accounting period. Understand? A company has received money. Cash flow has happened. Company has received money. But that money has been received in advance. We haven't done anything. Company has not provided any good or service. Okay. Money is received in advance. So this money is called as what? Unearned income or pre-received income or deferred income or income received in advance, because we have not done anything. We will provide goods or services in the coming days or in the next accounting period. Okay, that's what the thing is. See here, let's just say for example, we have received 1 lakh from our client, income received in advance, 1 lakh, 100,000. Out of that 100,000, let's just say, we have provided 30,000 of service. Okay, let's just say consultancy service to our client in the current accounting period. Fine. At the end of current accounting period, we have provided the service worth 30,000. So that 30,000 becomes our revenue or income, normal revenue or normal income. Okay, because we have provided the service, we have fulfilled the contract. Okay, remaining 70,000 we haven't provided the service. Yeah, we haven't provided the service for remaining 70,000. So that 70,000 we have not earned, even though we have received it. It's in our bank, right? It's in our bank, but we haven't provided the service. So from the accounting perspective, from the accrual concept perspective, yeah, on the basis of accrual, we say that we have not earned this income. Okay, this is our liability. Why is it our liability? Because we have to do something. We have to provide a service in future. Then only we'll earn that. Right now, it's not our money, even though it's in our bank. Is that clear? Fine. So that 70,000 relates to future accounting period when we will provide the service. Okay. So this is what happens when we receive the money. That entire thing was what? Deferred income, income received in advance. As the accounting period ended, the current accounting period, what happened? How much service did we provide? We provide 30,000 worth of service. So 30,000 became our what? So normal revenue or normal income. The remaining 70,000 for which we did not provide any service, we will provide in future. So that 70,000 became future income. Yeah, it is deferred income. We are postponing that income. Is that clear? It's unearned income. We have just received the money. We cannot recognize it as an income because we are following accrual basis of accounting, not cash basis. Fine. So this is income and this is deferred income. You understood, right? Okay. So income will go where? It will go in statement of profit and loss as a normal income, normal revenue, isn't it? Yes. But what about this deferred income? This deferred income or income received in advance or unearned income, what will happen of this? This is a balance sheet item. It's a liability. We have to do something for them. Yeah, we have to provide service in future, isn't it? We have to make future sacrifices because of this, right? Isn't it? We have to provide economic benefit. We will not receive economic benefit. We have to provide economic benefit. Is that clear? So it's our liability, and that money is not our money until and unless we provide the service. Is it clear? Right. So it's our liability. It has to go in balance sheet or statement of financial position also, you can say. Is that clear? This is what is deferred income. I hope you have understood. It's really simple. Yeah. We receive the money, 100,000. At the end of current accounting period, we just provided 30,000 worth of service. That became normal income, relates to current accounting period. Simple and straightforward. Whatever we have not provided, we have just received money for that. That relates to future accounting period, future income. So it's a liability, has to go in balance sheet. Fine. Okay. So now you have to understand the backstory regarding this transaction. What happens in real life by the bookkeeper in the big company? That's what you have to understand. See, it's really simple. What happens is, the bookkeeper who has limited knowledge, he will pass this entry. Bookkeeper will usually record the entire amount received. We have received 100,000, isn't it? On the first day only, right? We haven't provided any service at that time only. We received 100,000. So what the bookkeeper will usually do, 90% of the time, bookkeeper will pass this entry, cash account debit or bank account debit. Yeah, we have received the money. Fine. He will debit that and he will credit the entire 100,000 to income account. I told you, from the accounting perspective, from the accrual basis perspective, only 30,000 relates to current accounting period. Only 30,000 is income and remaining 70 is liability, has to go in balance sheet. But what the bookkeeper did, bookkeeper took entire 100,000 to the income account. Entire 100,000 will go now to statement of profit and loss, which is not right, isn't it? This entry he has passed in this income account. Understand, in this 100,000 there is 30,000 income as well as 70,000 deferred income. Fine. Both are there in this and both are going to statement of profit and loss, which is not right. 30,000 has to go to income account and 70,000 has to go to deferred income account. Is it clear? Fine. So this is not right, but this is what will happen. This is what will happen. I told you this is what will happen, right? The accounting system is designed like this. Fine. That bookkeeper advice, you just pass routine transaction, don't focus on this accrual and prepayments and all. Okay, if the cash is coming in, just debit, cash is going on, just credit. Yeah, simple purchase, sales transaction and all you have to do, right? And expenses entries and all. Fine. The complex things regarding accrual and prepayments will be done by the senior accountant. So what happened then? At the end of accounting period over here, at this red line, the end of the current accounting period, the senior accountant came and he'll have to pass an adjusting entry. What adjusting entry? What he has to do? Understand what the bookkeeper has done. Bookkeeper has taken entire 100,000 to income account. So what the senior accountant has to do? Senior accountant has to reduce the income account by 70,000. 100,000 has gone over here. Only 30,000 should be there. So senior accountant has to reduce income account by 70,000. So see here, reduce income account by 70,000. And that 70,000 has to go where? In deferred income account, which is a liability account, right? So he has to record deferred income or income received in advance or unearned income. Okay, whatever the account title is, you can take. Fine. So this entry needs to pass. This double entry. Income has credit balance. To reduce it, you will have to debit it, right? Income count has to be debited. Fine. And it will be reduced. All right. Sorry, here it's wrong. It's okay. I will change it. This is actually decrease. Okay. Income needs to be reduced and then deferred income has to be increased. I'm really sorry. Both are wrong. This has to increase. Okay. Deferred income has to increase. Income account debit to deferred income. Is that clear? Deferred income is a liability account which has credit balance. You are crediting it to increase it. Is that clear? Simple and straightforward. Fine. Understood. Now this is the adjusting entry, and then in the next accounting period on the first day you will have to pass the reversal entry, exact opposite of that. We'll see that in the example. Fine. And then in the statement of P&L, what will happen? In the statement of P&L, in P&L account, what will happen? You have to reduce from income, isn't it? What happened in the journal entry? You reduce the income by 70,000. So you have to go to that fees income, for example, and you have to reduce 70,000 over there. Okay, in statement of P&L, reduce from income, right? And then in balance sheet, what you have to do? You have to show 70,000 as deferred income as a current liability. Is that clear? This is what you have to do. And then reversal entry will happen in the next accounting period. Fine. This adjustment depends upon what has happened in the current accounting period. Remember this. Okay. At last, we'll discuss alternatives also. Okay. Alternative treatment by the bookkeeper and what adjustment we need to do. That we'll discuss at last after the example. So now let's just go to an example and let's just discuss this further. Okay. Now see here we have a beautiful example on deferred income. It's really simple and straightforward. And let's just say we are ABC Consulting Company. We have this building where we do all our operations and our 6th floor is unoccupied and we have no use of it. Okay. So what did we do was we rented that space out, that entire floor, to another company, a third party. Right? And that's what most of the companies do, right? They rent out the unoccupied spaces which they have no use. Is that clear? Okay, so that's what we did. And the rent per year was 10,000, let's just say. Is that clear? And the rent which we receive from tenant on the day when we sign the contract, let's just say, is 30,000. Fine. I've kept the figures simple so that you can easily understand the concept. Maybe the rent can be in millions. Fine. But right now we are just keeping things simple. The figures are just 10,000, 30,000. All right. 10,000 is the annual rent and the amount which we received on the day of contract is 30,000. So now you can easily understand what is happening over here is we have received money from our tenant, right? That other company or the third party, 30,000, which is the rent of 3 years. So 3-year rent we have received in advance on the first day itself. Yes. Do you agree? So this is what rent received in advance. Now I will ask you one thing. Tell me, have we earned this 30,000 entirely? Have we earned it? Is it our income? No. You will say no, it's not our income. We know, we have understood the concept of deferred income. right? We haven't provided any service on the first day, right? They have not done their operation on the 6th floor on 1st April 2023, right, of 30,000. No, yeah, they have just signed the contract, fine, and we have received the money of these periods entirely on the first day only. So this entire 30,000, you will say it's deferred income, right? Now let me ask you the question again by rephrasing the question. Let's just say 1 year has been passed. Let's just say 1 year has been passed from 1st April 2023 to 31st March 2024. This is our first accounting period. Okay, our year ends on 31st March 2024, and then we have second accounting period, third accounting period. Okay, all right. So at the end of first accounting period, tell me how much is our income and how much is deferred income out of this 30,000. You will say, sir, it's really simple. We have understood the concept. Out of this 30,000, if 1 year has been passed, then out of this 30,000, 10,000 we have earned because that third party, that company, and has done their operations on the 6th floor for this entire year. We have provided them the service of 10,000. So 10,000 we have earned. Remaining 20,000 we have not earned. It is of future period. It's deferred income. We'll have to postpone those incomes, isn't it? This is what your answer should be. All right. Okay. So now let's understand the backstory. The backstory in the sense what the bookkeeper has done, what our junior accountants who have limited knowledge, what they have done regarding this transaction. Okay. So see here, on 1st April 2023, this is the double entry or the journal entry which is passed by the bookkeeper. 1st April 2023, cash account debit. Yeah, we have received the money. Cash is our asset, so they debited that 30,000. Right, it's absolutely right. Yeah, asset is a debit balance thing, and to increase it you debit it, and then they credited to rent received 30,000. Rent received is an income account. Okay, you can say as rent revenue, rent income, or rent receipt. Is that clear? So this is just an account title. It's an income account. Fine. So the bookkeeper took the entire 30,000 to income account, and that's what I told you, isn't it, while discussing the deferred income concept. Yeah, 90% of the time what the bookkeeper will do, the guy who has limited knowledge, he will take the entire amount received as an income, right? So in that income account, what will happen at the year end? In that income account, there will be some part which is income, and then there will be part of deferred income also. Both will be combined in this, which is not right. So that's why we need an adjustment, isn't it? See here, the entire 30,000 has gone to income account. Out of this, you definitely know, out of this 30,000, only 10,000 we have earned. Only 10,000 is our normal income, rent received income. Remaining 20,000 is our deferred income because we have not provided the service, right? That third party has not done their operations in the second and third accounting period yet. Yeah, it will happen in future. In future years, we will earn that, isn't it? So what we have to do as a senior accountant, see here, at the year end, this will be the position of the trial balance. In the trial balance, rent receipt will be appearing as 30,000. Is this right? You will say it's not right. But the accounting system has been designed like that the bookkeeper are advised, don't do accrual and prepayment, complex things and all. Just do routine transaction, and some planned mistakes also you have to do it, right? Later onwards, the senior accountants will correct everything. Is that clear? This is a planned mistake actually. Fine. All right. Okay. So this is the thing. So then adjusting entry is needed on 31st March 2024 at the end of this accounting period. What adjusting entry? Come again to the concept of deferred income. This adjusting entry. Yeah. You have to reduce the income account. Out of this 30,000, you have to reduce how much? 20,000 you have to reduce. 10,000, 10,000, yeah, of future. So that you have to reduce. Isn't it? I told you, whatever that is of current accounting period, in this case 10,000, it will go statement of P&L, yeah, as an income. But whatever that relates to future accounting period, it is a deferred income, it's a liability, has to go in balance sheet, right? So the adjusting entry is reduce the income account by 20,000, and 20,000 you have to record as deferred income, right? So see the adjusting entry over here, 31st March 2024 at the year end. Yeah, over here you are passing this rent received account to deferred rent. Is that clear? What is that Rent received account, it's an income, you are debiting it. Understand, rent received is an income or revenue account. It has credit balance. You have to decrease it by 20,000, so you are debiting it by 20,000. Fine. And then this amount has to be recorded as deferred rent. Deferred rent is a liability. Liability has credit balance. To record, you have to credit. Okay, you have to understand all the rules and everything. Okay, this entry you understood, it will be passed by the senior accountant. After this, what will happen? The senior accountant will prepare the financial statements. But first, you have to understand properly how much will hit profit and loss, right? So for that, you have to prepare a T account of the income account, yeah, of rent received. Rent received is an income account. See here, rent received is an income account. It has credit balance. Credit means plus, debit means minus. Is that clear? Okay. So first, what happened? First, we received 30,000. The bookkeeper took that entire 30,000 to rent received account. So rent received account increased by 30,000 because of the money which we received by cash or by bank. Is that clear? This posting of this entry, yeah, rent received was credited because of cash, right? This posting we did. And then what happened? And then the adjustment happened by the senior accountant, where rent received was debited. It was decreased by 20,000. So rent received was decreased by 20,000 because that 20,000 is actually deferred rent. So it went to deferred rent. Is that clear? You understand the logic? Okay. Then what you have to do, nothing else happened. You have to balance the account. 30,000 is the bigger side. So 30,000 on both the side. 30,000 minus 20,000, that's equal to 10,000. This is the balance. This balance of income account will go where? It will hit profit and loss account. You all know income and expense accounts always gets closed. It becomes zero at the end of the accounting period because the balances flow and hit to profit and loss account. And there we calculate the profit or loss by making what? Income minus expenses, right? That's what happens. So see here, this 10,000 will go over here. See, 10,000. Is that clear? But now what is this presentation? See, understand. In financial statement questions, in final account question, mostly you will not do this. Yeah, they don't do this. What they do over there is, see, understand. In the question, they give you the trial balance. Rent received 30,000. And then below that, in additional information, they tell you that out of this 30,000, 20,000 is deferred rent received. Yeah. So what do? When you prepare the P&L, you take the rent received from trial balance 30,000 and then you subtract from the additional information which was given 20,000 deferred rent 20,000, right? You subtract that and you get 10,000 over here. Or directly also you can do, which is directly prepare this T account, take 10,000 directly from over here, rent received 10,000. Both the options you have. Okay, so this is the entire logic, how it all flows, isn't it? While explaining the concept, I told you, see here, in statement of P&L, you're not passing the adjusting entry. Yeah, when you do the questions directly, if you're doing in the financial statements, the adjustment, what you have to do, you have to go to that particular income. Yeah, we are talking right now about rent received, right? This is the income we are talking about. So you have to go to rent received, that income, yeah, and then you have to reduce from that income. You have to reduce income from that income. Okay, reduce from income. So see, this is what we did. Now understand one thing. Most of the people think that we are taking deferred rent over here. No, that's completely messed up. How deferred rent can come in P&L? In P&L, only incomes and expenses comes, right? Only expenses and incomes go in P&L. So here, this is just presentation. What are you doing over here? Rent received 30,000 minus rent received 20,000 only. Both are income only. Okay, you're just reducing that. The presentation is like this, deferred rent. You're just giving the reason over here. This is not the liability. Liability cannot go in P&L. This is just presentation. Is that clear? Okay, so 30,000 minus 20,000, that's 10,000. Is it clear? Okay. And then in balance sheet, what will happen? In balance sheet, you all know that deferred rent. Yeah, this thing. See, here you credited now deferred rent in adjusting entry. This is a liability. It has to go in balance sheet. Yeah, it will exist. Is that clear? See here, in balance sheet, deferred rent will come over here, 20,000. What's the impact in the financial statement? In P&L, you reduce the income over here. So in that accounting period, if there is a profit will decrease. or if there is a loss, loss will increase. This is the impact in P&L, in statement of P&L or P&L account, whatever it is. And in balance sheet, the impact is liabilities will go up because of the adjustment entry I'm talking about. Is that clear? Isn't it? You recorded the liability over here, so liabilities will go up. Is that clear? Fine, understood. So what is the purpose of adjusting entry? The purpose of adjusting entries is to bring the financial statements in accordance with the accrual basis. Fine. And it's accurate also. So when now any shareholder, any banker, lender, creditor, whoever it is, they will see the financial statement, the employees, the managers, whoever it is, they will come to know accurate financial performance, the profit or loss which has been earned by the company, and the financial position of the company. Is that clear? That this company has a deferred rent of 20,000, accrued income, whatever it is, whatever the case is. Is that clear? Here it's deferred rent. Fine, understood. Got it. So this was the reason why we passed the adjusting entries. Once this is over, preparation of financial statements is over, then what we have to do, next accounting period will start, second year. In the second year, on the first day, what you have to do is understand, you have to reverse this adjusting entry. Whatever you passed over here, entire opposite thing you have to do. See, in the second year, this entry you have to pass. Reversing entry or reversal entry, we call it. 1st April 2024, first day of new accounting period. 1st day of new accounting period, 1st April 2024, deferred rent to rent received 20,000, 20,000. This will be passed by the senior accountant. Okay. See, rent received to deferred rent 2020. Here you are doing deferred rent to rent received 20,000, 20,000. Is that clear? What's the logic of this entry? The first thing is you are cancelling the deferred rent account. I told you deferred rent account is a liability account which will exist in the next year also. Yeah, whatever that goes in balance sheet, it exists in the next year also. So deferred rent is a liability. It has credit balance. To finish it off, you debit it. Okay, to finish it off, you debit it. See here, liability has credit balance. To decrease it, you debit it. Fine. And then you are recording rent received, an income of 20,000. Why? Because understand, in this second accounting period, the rent will not be received because rent already has been received on 1st April in the previous year. So here, if you do not record the rent in the reversal entry, then the bookkeeper will not pass any entry of that. The rent income will be missed. It will be omitted. So that is why you have to pass the reversal entry to record that. So that's what we did, to rent received 20,000. Is that clear? Understood. See, no rent will be received in this year because the rent of this year is already received in previous year. No receipt entry. Fine. Therefore, no receipt entry. Is that clear? Okay. So then the year end will come of the second accounting period, 31st March 2025. At this time, the trial balance will be prepared by the bookkeeper. Okay. And he will, see the ledger account which he has prepared and everything, right? This rent received has flown to the T account of rent received, 20,000 gone over there, and that 20,000 has hit profit and loss, and then it has come in the trial balance also, right? Isn't it? Yes. So this will happen. Then the senior accountant will come to prepare the financial statement, balance sheet, profit and loss and everything, cash flow statement. At that time, he will see the trial balance. Oh, rent received is 20,000. How is it 20,000? It's not 20,000. Yeah, in the second accounting period, the rent is how much? Just 10,000 per year, right? So senior accountant will understand, okay, I need to make an adjustment over here, right? Because reversal entry, I passed 20,000, which I have to fix, isn't it? Yeah. So what he will do? He will pass the adjusting entry. Let me just show you. The adjusting entry would be this, 31st March 2025. When he is passing this here, okay? 31st March 2025 at the year end, rent received 10,000 to deferred rent 10,000. Yeah, how did he pass this entry? See, understand, it's really simple. Out of this rent received 20,000, 10,000 is relating to current accounting period, which is an income, but the remaining 10,000 is deferred income. So that much he has to reduce, isn't it? Remaining 10,000 he has to reduce. So rent received, he debited and he reduced by 10,000, and that 10,000 he recorded as deferred rent. Is that clear? Simple and straightforward. This is the adjusting entry. Yeah, you know. And then the financial statement will be prepared of second year. Yeah, of second accounting period. Here only, 31st March 2025. So the financial statement, see here. First, the T account is prepaid of rent received of that income account, which has credit balance. Credit means plus and debit means minus. Okay. So first what happened in the second accounting period? In the second accounting period, first reversal entry happened. So let's see in reversal entry what happened. In reversal entry, see, rent received account was credited because of deferred rent. Yeah, rent received was recorded because of deferred rent, right? So rent received increased. Yeah, rent received was credited because of deferred rent by 20,000. Okay, and this is called as opening balance, and this happens because of reversal entry. Okay, I will explain you the format, don't worry. And then what happened? And then adjusting entries. Adjusting entry was passed. This entry, rent received was debited by 10,000 because of deferred rent, right? So rent received was debited, which means it was decreased by 10,000, yeah, because of deferred rent. Is that clear? And this is the closing balance, and closing balance happens because of adjusting entry. How? See, understand. Reversal entry is passed at the beginning of the year. Opening balance is caused because of reversal entry, and then adjusting entry is passed at the end of the accounting period. So that is why the closing balance is caused by the adjusting entry. Is that clear? Okay. So see, adjusting entry, rent received was debited. Rent received was debited because of deferred rent. Okay, this is the closing balance. And then see, 20,000. Yeah, the credit side is bigger, so 20,000 on both the side. 20,000 minus this 10,000, that's equal to 10,000 balance, which will hit profit and loss account. Is that clear? Fine. So now what's the shortcut of preparing this? The shortcut of preparing this is very simple. Understand. Okay, deferred rent is liability account. Deferred rent is a liability account. Remember, liability account always have opening balance on the credit side and closing balance on the debit side. It's always like this. Fine. So here also you have to remember that opening balance of deferred rent will be on the credit side and closing balance will be on the debit side. Fine. See the format over here, format of income account with maximum adjustment. We also saw this in the previous video as well when we understood the accrued income, right? Accrued income was an asset account, right? So it has opening balance on the debit side and closing balance on the credit side. Now we are talking about deferred income, which is a liability, opening balance on the credit side because it has credit balance. Yeah, credit side and closing balance on the debit side. Is that clear? Okay, so this is what you have to take in the income account. Fine. And then payment will always come on the credit side. Yeah, income increases, you receive the income, right? And then balancing figure will always come over here, which will hit profit and loss account as you saw over here. Is that clear? Yeah, and here also, yeah, previously also we prepared rent received account. See here, cash is coming over here. Yeah, P&L always over here. Is that clear? So you understood the format of income account. Fine. So we prepared this rent received account and we came to know that 10,000 is the balancing figure and 10,000 will hit the profit and loss account. So if you prepare the P&L account, see here, profit and loss account, see 10,000 has come over here, which is absolutely correct. Yeah. In the second accounting period, how much should go? How much is the income rent received? Only 10,000. So only 10,000 should hit P&L. Is that clear? But if you're doing directly in the financial statements, the adjustment, then what you have to do, you have to first go to the trial balance, take 20,000 from there. Yeah. So rent received 20,000. And then, you know, out of that 20,000 in additional information, you will be given 10,000 is deferred rent. So minus deferred rent 10,000. Yeah. You have taken the income and you have reduced 10,000 income from that. 20,000 minus 10,000, that's equal to 10,000. Is it clear? So this is how you have to do. And then you have the balance sheet. In balance sheet, what happens? In balance sheet, you have to show that 10,000 deferred. Yeah, this thing, adjusting entry, this 10,000 is liability. You have to take it over here as a current liability. Fine. Deferred rent 10,000. Is that clear? Simple and straightforward. Understood? Then comes the third accounting period, right? In third accounting period, what will happen? Yeah, we are done with the second accounting period also. Financial statements are prepared, P&L and balance sheet. And then in the third accounting period, on the first day, you have to pass the reversal entry. You pass this adjusting entry now over here. Right the next day, you have to pass the reversal entry. Exact opposite. See here, rent received to deferred rent, 10,000, 10,000. See here, deferred rent to rent received, 10,000, 10,000. Exact opposite. 1st April 2025, first day of new accounting period over here. Okay. Okay. And then this entire year will be passed and then the year end will come. And in this year also the same thing, no receipt entry. Okay. The third party will not pay us any money because they have already paid everything. Fine, no receipt of rent, no entry. Is that clear? Fine. So in the trial balance, what will happen? Rent received will come over here, 10,000. How it will come over here? Because of the reversal entry. Understand, in the reversal entry, what we have done, we have cancelled the deferred rent account. Yeah, you have cancelled this by debiting it. Deferred rent has credit balance. It is liability. To cancel, you debited it and you cancel that. Rent receipt you recorded by 10,000 when you did the reversal of this adjusting entry. Fine. On the first day of the third accounting period. So this will go to the T account and then the balancing figure will hit P&L, and in trial balance also it will appear, right? 10,000. Clear? And this is absolutely right now. Understand, no adjusting entry is required now. Why? Because see, only 10,000 is the rent now. So in trial balance of the third year, 10,000 is appearing, which is completely right. No adjustment is needed. Your transaction is getting finished over here. No receipt of rent, therefore no entry. Yeah, it's already paid. Yeah, okay. So adjusting entry is not required because rent income of 10,000 in trial balance is absolutely correct. Okay, this is what senior accountant is saying. Okay, okay. And then the financial statement will be prepared. The T account of rent received. See here, the same thing. Credit balance. Credit means plus, debit means minus. It's an income account. Okay. So here first in this third accounting period, reversal entry was passed, right? So reversal entry, see what happened? Rent received was credited because of deferred rent. Credited means it was increased. Yeah, rent received was increased. It was credited because of deferred rent. Okay, this is the thing. This is the opening balance of deferred rent. Fine. And then there is no closing balance. No adjusting entry was passed in the third accounting period because it was not required. 10,000 is absolutely correct. Yeah, yes. So 10,000 on both the sides. Okay, yeah, this is the bigger side, right? And then on the debit side, there is nothing. So 10,000 only, the balancing figure, which will hit P&L account. See, in P&L directly, you have to take 10,000 as rent received. There is no adjustment. Nothing has happened, right? And in balance sheet, there will not be any deferred rent because there isn't any deferred rent. Yeah, is that clear? Entire that 10,000 relates to that period only. Fine. You understood this? Really simple and straightforward. Yep. So this is the thing. So what did we do over here? When we received 30,000 and when the year passed, in that 30,000, 10,000 was normal income, 20,000 was of future years. So we took that to balance sheet. We couldn't take that to statement of profit and loss. Only 10,000 we took to statement of profit and loss. And then we passed the adjustment entry. Yeah, that's how we took to balance sheet and all, by adjusting entry. And then by reversal entry, we reversed everything. Fine. And then again the second accounting period ended, and in second accounting period here also we needed adjusting entry, right? As you saw, where 10,000 we left as it is, which went to profit and loss, and the remaining 10,000 we took to balance sheet by the adjusting entry as deferred income, isn't it? Yes. And then again here we passed the reversal entry, right, in the third accounting period in the beginning, and then that's what happened, right? So at last, finally, what happened? Finally, there was no need of any adjusting entry because 10,000 was absolutely correct, isn't it? 10,000 was absolutely correct. Is that clear? So if you have any doubts in this, please comment down below, okay? And I will, help you. So this is the thing. It's really simple and straightforward. It's not difficult. Now what we have to do is we have to understand the alternative accounting treatments. So let's just do that, okay? What if the bookkeeper does alternative accounting treatment? Then how the adjustment will be? Let's understand that. Now here we have the alternative accounting treatments that are done by the bookkeeper regarding the deferred income. Let's understand. I told you in the beginning only that when we do the adjustment of adjusting entries, yeah, deferred income or whatever it is, it's based on the history, the backstory, what has happened, how the transaction has been recorded by the bookkeeper. And I told you when we saw the practical example and everything that the bookkeeper here is recording everything as an income, the entire thing. In the practical example, 30,000 was there. That entire 30,000 rent received in advance was recorded as an income. In that, at the end of first accounting period, there was income as well as deferred income, both the elements, right? Yes. So in that case, we had to do this adjustment, reduce the income account by the portion of deferred income and record that much as deferred income. Yeah, this is what we did, this adjusting entry, right? This was the first case. Now alternatively, what can happen is the bookkeeper may record the entire amount received as a deferred income in the beginning only. Okay, so what will happen if entire thing is recorded as deferred income? See, let's understand with the same practical example. If this 30,000 is entirely recorded by the bookkeeper as deferred income, cash account to deferred rent, 30,000, then what will happen is, in that 30,000 which has gone to deferred rent account, in that 30,000 there will be income element as well as deferred income element, both. Yeah, at the end of the first accounting period, 10,000 service we have provided, so 10,000 we have earned, it has to go to normal income account and it has to go to profit and loss, it's normal income. But the remaining 20,000 which we have not provided, the service, for that we need deferred income account only. So what the senior accountant will do in this case, if entire 30 has gone to deferred income, senior accountant will have to pass an adjusting entry to reduce the deferred income by 10,000 amount, the income which we have earned at the end of first accounting period. Okay, so deferred income account debit 10,000 to income account 10,000. If we use the account title, then it will be deferred rent account to rent received account. Is that clear? 10,000, 10,000. Reduce deferred income account by the amount it has been earned and record that as an income. Yeah, at the end of first accounting period, we have earned 10,000, right? So we have to record that as an income and reduce the deferred income by 10,000. Is that clear? This is the adjustment. So this adjustment is based on this particular backstory only if this happens. Okay, and then the second alternative that can happen by the bookkeeper is the bookkeeper may record the correct bifurcation. What do you mean by correct bifurcation? Correct bifurcation means the bookkeeper is very very proficient, he has high knowledge. So what he does, and the accounting systems are designed like that the bookkeeper is given the the authority to record accrual and prepayments. In that case, what he will do, when 30,000 was received by the company, at that time only the bookkeeper will do the calculation. By the end of the current accounting period, what will happen? He will estimate and he will pass the entry. He will say 30,000 we have received. Okay, fine. Cash account debit. Fine, that's correct. But he will do the estimation, and at the end of first accounting period, till then, how much will be our income, he will estimate, or he will do the calculation. He will say 10,000 will be our income. So to income account 10,000. Correctly, he will record the income 10,000, which relates to current accounting period and for which we have provided the service. And then the remaining thing which relates to future accounting period, for which we have not provided any goods or services, right, which we have to provide. So in that case, he will record deferred income properly. So the entry will be cash account debit 30,000 to rent received account 10,000 and to deferred income 20,000, which relates to future accounting periods for which we have to provide service in the future. Okay, this is what he will do. If the bookkeeper records like this, the correct bifurcation, then the senior accountant have to pass no adjusting entry. No adjusting entry is required. Okay, you don't have to pass anything. Is that clear? So these are the two alternative accounting treatments by the bookkeeper and their respective adjustment. Here the adjustment is required and here it's not required. Is that clear? So that's all for this video. I hope you have understood it. Okay, if you have any doubts in this, please comment down below or just take a screenshot and just message me on Instagram. Okay, so that's all. See you in the next video. Bye.